Hello and welcome to today's video. We're going to talk about cost segregation and bonus depreciation in non-conforming states, specifically focusing on California. Let's start by understanding the basics. Cost segregation is a tax planning strategy used by real estate investors to accelerate their building's depreciation. This increases their current deductions, reducing their taxable income. Under normal circumstances, real estate assets depreciate over 27.5 years for residential property and 39 years for commercial property. But with cost segregation, certain components of the property can be depreciated over 5, 7, or 15 years. This gives you larger deductions in the early years. Now, what about bonus depreciation? This is another tax strategy that allows you to depreciate a large percentage of qualifying property in the year it was placed in service. That's a big tax break. Let's take a look at an example. Here is a quote for a $950,000 property. If you elected to bonus the personal property, you can receive a $252,000 deduction for your federal taxes, leaving a smaller amount of annual depreciation in the following years. If you chose to accelerate the personal property without electing to bonus, the first year would offer a $41,000 deduction. This leaves more depreciation deductions in the following years. In this example, the next 4 years of depreciation would be $67,000, $50,000, $40,000, and $37,000, respectively. If someone was lucky enough to own several properties and have a $250,000 income, you could stagger them out one per year and greatly reduce your tax bill. For most clients, this strategy can work quite effectively. But here's where it gets tricky. Some states, like California, are non-conforming, meaning they don't conform to federal bonus depreciation rules. So, while you can claim bonus depreciation on your federal taxes, you can't do the same for your state. In a state like California, our previous strategy still works, but would leave $210,000 of taxable income to the state. At approximately 8%, the client could still owe an additional $16,000 per year. For this, we have a simple but elegant solution. Instead of staggering the properties, one per year with the bonus, leaving a considerable amount of state taxes, you stack them into 1 year using the traditional cost segregation allocation and allow the total for each year to reduce both federal and state taxes. Now that you have taken the bonus out of the equation and have elected the traditional cost segregation times 5 properties, the annual depreciation would look like this and count for both federal and state taxes, saving a significant amount of money on the upcoming tax bill. To find out more and learn more strategies like this one, visit rcgvaluation.com.